co-founder and CEO of Key Advisors Wealth Management. Eddie, it's great to see you on this Monday morning. What do you make of the markets at these levels?
You know, these markets continue to surprise people to the upside. And one thing that has held true since April, once we made that V-shaped recovery, is dips are going to continue to be bought, in our opinion, because people are underinvested. This is probably one of the most hated bull runs I've seen in my 28-year career. And as we continue to make new highs, more and more people continue to doubt it. And we continue to see large institutions go net short in small caps in the S&P. So that tells us there's still plenty of upside over the next 6 to 8 months because we have not capitulated to the upside yet. And the last leg of a bull market is generally one of the strongest. So at the end of the day, I think investors just need to break it down to the simplicity that over the next 12 months, we are not in a recession and we have a Fed that's going to be loosening monetary policy. That's as bullish as an environment as you can ask for risk assets. So increasing liquidity while the economy is strong should favor stocks and the higher risk stocks. So we continue to be extremely bullish and buying dips in any opportunity we get.
Are there certain sectors, Eddie, that you anticipate will outperform?
We do. We think as you're starting to see, which is continuing to give us even more of a strong bullish consensus, is things are broadening out. So we have increased consumer discretionary names. We've increased crypto last week for our clients, for some of our clients, small caps as well too. And to me, those areas are going to outperform the S&P because they have a lot of catching up to do. And small caps just got to their 2021 levels just the last week. So in our opinion, as we go into next year, if the economy accelerates as we anticipate while the Fed's cutting rates, that's a fantastic environment for small caps.
You know, I'm glad that you mentioned small caps. It is good to see them now at a record high, of course, joining the other major indices there. We've seen a lot of momentum, it seems, in technology, Eddie. Certainly some of these riskier technology stocks like the AI trade underperformed in April amid the market volatility, but it does seem as if they have strength. So I want to get your take on that sector and if you would liken the momentum to anything we've seen in the past.
So I'm looking at this time period like the 90s during the internet boom, and this is the AI boom, and it's real and it's going to be bigger. So we still own some of the high flyer tech names out there that are tied to AI. I think you're going to continue to see more and more adoption there. So, you know, just because the market's broadening out and we are seeing opportunities in other areas, we still respect the fact that the AI trade and the tech trade is going to probably continue to lead, because the minute that technology breaks down due to the concentration that they have in the indexes is probably the beginning of the end of the bull run. So it's extremely important that these names continue to do well and lead this market. So we still have quite a bit of technology exposure. You just don't have to be all in tech because there's other areas now that are showing a lot of strength.
I want to talk to you about gold because I know throughout this year, Eddie, you've been bullish on gold, that commodity at another all-time high. Are you still bullish on gold?
Absolutely. And we were joking as a team last week and said, who would have thought that buying gold for clients and replacing some bonds with gold, which was the decision that we made, would have been one of the best investment ideas for clients, outperforming the S&P last year and really outperforming by a wide margin again this year. And one of the things that you're seeing, and it's now starting to get documented, is governments around the world are continuing to accumulate gold with no intentions of selling. So you have natural buyers there. And now you have some pretty big money managers that are just now coming out and saying you should have 10 to 20% gold. After an 80% move, they are now coming out and say that. So I think what that indicates is more money flows are going to continue to go into gold as we continue to see the debt bubble around the world continue to increase. So we still have gold. We're going to continue to hold it until the signals tell us to get out. But we think this is a multi-year trade.
Of course, interest rates keenly in focus. Eddie, what is your take on how many cuts we see from the Fed the rest of the year?
I think we'll get one more this year. I don't think we're going to get two more this year because I think inflation, they have a really tough job right now. Inflation's not going to come close to their 2%. So we think they're going to end up having to throw that out the door. But one of the things is if you start to see the economy really accelerate, if they cut too aggressively, you'll see the 10-year bond really spike. And to me, the 10-year bond is much more important to track than the federal funds rate. So they'll cut one time, I think, this year, and then maybe two times next year. Again, the most important thing as an investor to understand is they're not going to be raising rates. They're going to be trending lower over the next 6 months. So whether it's 2 cuts or 5 cuts over the next 8 months, to me, doesn't matter. What matters is they are going to be loosening policy at a time that the economy is going to be accelerating on the growth side.
What does this mean for comparison's sake when it comes to the performance of U.S. equities versus what we've seen with international stocks? And I ask that, Eddie, because we know the president has noted, and we've seen other international markets cutting rates sooner than the U.S.
So we continue to be, in our tactical strategies, we don't have any international exposure. We are staying in the U.S. And the reason why is we are just now getting into our rate cutting cycle. Okay, so this is the early innings of this rate cutting cycle at a time when things fundamentally are going to be getting better. And so we think tilting to U.S., again, we're 100% U.S. in our tactical strategies. We think they will outperform the international markets. And we believe they're going to be more predictable. Because one thing with this administration is they tell you what they're going to do and they execute it. Whether you agree with it or not doesn't matter. And when you have an administration that's transparent in what they're going to do, it does make it a little bit easier in regards to what direction you want to go as an investor.
All right, Eddie Ghabour joining us remotely this morning. Eddie, thank you so much. He's a co-founder and CEO of Key Advisors Wealth Management.
Thank you for having me.
Thanks for joining.